Welcome to the Deep Dive. Today we're looking into the making of a stock picker. We've got sources detailing the, well, pretty surprising origins of a major investor.
Yeah.
Not your typical math whiz story.
Mhm.
So our mission for you is to pull out the really practical, maybe even counterintuitive lessons here. What we found points to simple observation and clear logic beating complex models.
Yeah, and we have to start right away by challenging, that core idea. The sources flat out say there's no such thing as a hereditary knack for picking stocks.
No magic gene, then.
None! It's learned. You learn it through experience and sometimes, let's be honest, through making some pretty painful mistakes.
Okay, so let's talk about this unusual education path. It started super early, right? Age 11?
11 years old. But not in school. He was a caddy.
A caddy at Brayburn, that exclusive club near Boston.
Hmm.
How does carrying golf clubs teach you investing?
Well, think about it. It was like this total immersion course in how business really works.
Right, because his clients were.
They were the bigwigs, CEOs, company presidents. He wasn't just, handing them clubs. He was hearing unfiltered talk about deals, strategy, mergers.
So like a fly on the wall in a boardroom, but on a golf course.
Exactly. An incredible informal education you just can't get from a textbook.
And that real-world stuff seems to have really shaped his formal education choices. Because when he got to college, he skipped business school entirely.
He did. He went for history, philosophy, ancient Greeks, things like that.
Which seems odd for a future Wall Street legend.
Maybe at first glance, but he explicitly said logic is the subject that helped most in picking stocks. The connection he made, and that the sources highlight, is how Wall Street often gets lost in theory, kind of like the Greeks debating endlessly.
Instead of actually checking the facts on the ground.
Precisely. His education taught him how to build an argument, spot flaws, see if the basic premise holds up in reality.
Okay, so that practical mindset, that paid off pretty quick. 1963, Flying Tiger Airlines.
This first big hit.
He bought it at, what, $7 a share? Just because he read an article about air freight.
Yeah, basically. Just simple observation about future potential. And it turned into a five-bagger.
5 times his money. Wow.
A huge win. But importantly, right after that came the counter lesson, the failure.
Main sugar.
Main sugar looked great on paper, a sure win situation, he called it.
But it wasn't.
Not even close. It completely tanked. Why? Because the real world part, the execution, just collapsed. The farmers wouldn't grow the sugar beets, or maybe the refinery itself went bust. The sources differ slightly on the exact failure point, but the core issue was execution.
Wait a minute. So a financial model could have shown perfect numbers, but the whole thing failed because farmers in Maine didn't cooperate.
That's the gist of it. It underlines how, execution risk, people involved, can just completely wreck even the most elegant spreadsheet.
That's a harsh lesson.
Or a really harsh lesson. And he learned it fast. He swore, never buy another stock that depended on Maine farmers. That specific failure really cemented his skepticism of abstract models.
And that skepticism carried over to his later academic exposure, like at Wharton.
Absolutely. He encountered theories like the efficient market hypothesis and random walk theory.
Which basically say you can't consistently beat the market because prices reflect all information already.
Right. And he just didn't buy it. He found the actual practitioners back at Fidelity, the people doing the work, were much more grounded in reality.
Why did those academic models fall short for him?
Well, because they seem to dismiss the value of deep bottom-up research, the kind of fact-checking he learned the hard way with Maine Sugar. It felt like academia was building these sort of beautiful theories that just didn't match the messy reality of business. He trusted what he could see and verify over, elegant assumptions.
And that mixed the philosophy, the skepticism, the real-world checks, it obviously worked, leading the Fidelity Magellan Fund.
Yeah, the results speak for themselves. Took it from, $20 million to $9 billion.
An absolutely staggering run.
The ultimate proof of his unconventional approach, really.
So bringing this back to you, the listener, what's the simplest takeaway? There's this great quote mentioned in the sources from Will Rogers that seems to capture the whole philosophy.
Yeah, the Will Rogers quote. It's almost deceptively simple.
Don't gamble. Take all your savings and buy some good stock and hold it till it goes up, then sell it. If it don't go up, don't buy it.
Sounds almost too easy, right? But break it down. Don't gamble means don't speculate. Buy good stock means buy based on facts you can observe. Hold it till it goes up implies your facts were right.
And the kicker, if it don't go up, don't buy it.
Meaning if the reality doesn't match your thesis, your facts were wrong, or things changed, your assessment was flawed. It's all about that feedback loop with observable reality, not just theory.
Okay, so let's leave our listeners with something to think about.
Right. So, given how much emphasis this incredibly successful investor placed on logic and philosophy, maybe even history, how could consciously studying subjects outside of pure finance or business actually give you an edge today?
Could understanding literature or sociology or maybe even art help you analyze investments better than someone just staring at financial data?
It's an interesting question, something to definitely chew on for your next investment decision.
Okay, welcome to the deep dive. Today we're going to really dig into professional investing. There are some surprising contradictions there, right?
Oh, absolutely. It's fascinating.
Yeah, and we're looking at why maybe, just maybe, being an individual investor, doing it yourself, might actually give you an edge over the big guys.
It's a huge paradox right from the start. I mean, your sources show institutions, we're talking pension funds, mutual funds, they control nearly, 70% of all shares?
70%, yeah. Huge amount.
But then the same sources describe many of these professionals as, well, Wall Street oxymorons, like military intelligence, that kind of thing.
Okay, so lots of control, but not great results.
Generally, no. Most fund managers just don't beat the simple market averages consistently.
Which makes you wonder, why do they even exist then? If they can't beat the market? It feels like the system rewards just following the herd, not actually performing well.
It often does seem that way. Safety in numbers, perhaps, but, success is possible. You just have to look at the outliers, the exceptions.
It's like John Templeton. He saw that 72-74 collapse coming, didn't he? Went totally against the grain.
He did. Positioned himself in foreign stocks while everyone else was, panicking. His fund grew massively. 17-fold, I think.
Wow. And what about others, like Max Hine or John Neff?
Yeah, similar story. They were known for sticking their necks out. They deliberately went after deep bargain stocks, the ones nobody else wanted. Totally out of favor.
Stuff the rest of Wall Street had basically written off.
Exactly. Success often requires that kind of independence, thinking differently.
Okay, so if being contrarian works for these few, why can't the big firms do it? They have all the analysts, all the resources. This brings us to street lag, right? That's what your material calls it.
Yeah, street lag is a good way to put it. It's really the core reason why 99 out of 100 professionals completely miss those truly spectacular stocks.
99 out of 100, that's a lot.
It is. Think about the limited. Great example. When it went public, institutions basically ignored it. Just one analyst followed it back in 74. By 1979, the stock was starting to, really take off. But get this. By 1983, it was up 18 times its 1979 value. 18-fold.
Incredible. So where were the professionals then?
Well, that's the point. 37 analysts only started covering it in 1983. They completely missed the boat on that massive early growth.
They missed the entire run-up. That delay.
Yeah.
It can't just be accidental. There has to be some internal reason, right? Your sources mentioned something called the inspected by four method.
That's it. It's like this internal checklist. Fund managers almost look for reasons not to buy something. They need to tick all the boxes.
What kind of boxes?
Things like, is the management approved? Does the company have a proven track record? Is it in a designated growth industry? It's very rigid.
So potentially great companies get screened out just because they're new or maybe a bit unconventional?
Precisely. Think about early Walmart or Lick-Into Motor-Ins. They wouldn't have passed muster. They were blacklisted by these rules before they even got going.
That's just amazing. It really sounds like job security trumps portfolio returns. Avoid risk at all costs.
Yeah, it leads straight to what the sources call acceptable mediocrity. You don't get fired for being average, right? But stick your neck out on a losing stock.
Yeah, heads could roll.
Absolutely. There's intense pressure. We saw that example, Boondoggle, was it, forced to sell his Seven Oaks stock.
Even though it was a potential 10-bagger.
Mhm.
Just for clarity, that's a stock that goes up 10 times.
Correct. 10 times its value. But his bosses wanted it gone, basically burying the evidence that an unconventional pick could work just to, tidy up the books.
Wow. Okay, so internal pressures, fear, and then their actual rules, structural hurdles. The Oysters-Rockefeller constraint. What's that about?
Ah, right. That refers to actual regulations limiting big funds. An equity fund, for example, usually can't own more than 10% of any single company's shares.
10%. Okay.
And often they can't put more than, say, 5% of their fund's total assets into just one stock.
Now, this is really key for you, the listener. Think about what that means. These rules physically stop the huge funds from buying meaningful stakes in small, fast-growing companies.
Exactly. They just can't invest significantly in the next potential Seven Oaks or Dunkin' Donuts or Pep Boys back in the day. Those small caps where the real 10 backers often come from.
Because even a big position for the fund would be too small to move their overall needle, or it would break those ownership rules.
Right. So the system, fundamentally, it's built for security, for managing risk across massive portfolios. It's not really designed for spectacular company-specific success.
So if you invest like an institution,
You're pretty much doomed to perform like one. Average, or maybe slightly below average, which leaves all those exciting, high-growth, small company opportunities wide open
for who?
for smaller independent investors. For you.
Right. So the big takeaway here seems to be maybe the best place to find great investments isn't Wall Street.
Often, no. It might be right in your own neighborhood or your workplace. You might spot a great local company months, even years, before it gets big enough for the analysts to even notice.
It really suggests the market requires, well, conviction. You have to believe in what you're buying, maybe because you understand it firsthand. As the sources say, it victimizes the unconvinced. Something to think about. Okay, let's unpack this. We're diving into, well, one of the oldest debates in finance, really. Is investing just, a fancier form of gambling?
It's a great question. And we want to distill the core differences, look at stocks versus bonds, and figure out what prudent risk actually looks like.
Right, and we've got this amazing historical nugget to kick things off. It really shows the sheer power of compounding.
It does. Think about the Native Americans selling Manhattan back in 1626, right? For about $24 worth of goods.
That $24 story always gets me.
Yeah.
But explain the compounding aspect. Why does a small percentage change make such a huge difference over time?
Okay, so if that $24 had been invested, let's say it earned a steady, pretty conservative 6% compound interest rate.
For nearly 400 years.
Yeah, over that long haul, you'd be looking at almost $30 million today, which is, a lot.
30 million, okay.
But here's the kicker. If they'd managed to negotiate just a slightly better rate, say 8% instead of 6%.
Just 2% more.
Just 2% more. That same $24 wouldn't be worth $30 million. It'd be worth $34.7 billion.
Billion, whoa.
Billion with a B. That difference, that massive swing from just 2 percentage points, that shows you why time and the rate of return are just everything in finance.
Incredible. Okay, so let's tackle stocks versus bonds then. Bonds are often seen as the safe option, right?
Generally, yes. A bond is basically just debt. You're lending money to someone, a company, or maybe the government.
Like an IOU?
Exactly. And sometimes that's been incredibly attractive. Think back to the 1980s. Long-term interest rates hit, 16%?
16. Imagine locking that in.
If you bought a 20-year bond, then, yeah, you locked in an amazing return for decades. Very safe, very predictable.
But the real shine came during shocks, right? Like the 87 crash,
Yes.
October 19th.
Oh, definitely. Black Monday. People who were sitting in bonds or even safer money market funds, they felt pretty smart.
They must, though. They dodged the whole crash.
They did. And get this. For the full year, 1987, if you were just in a simple money market fund earning interest, you actually beat the S&P 500 index for the year. The S&P ended up 5.25%, but the money market funds, 6.12%. You won by staying safe.
Hold on, though. If sitting in cash beat the stock market during a massive crash, why wouldn't you just always play it safe? Why bother with stocks at all? Doesn't that 87 example prove safety wins?
But that's just 1 year. The long-term picture, well, it tells a very different story.
Yeah.
Historically, over decades, stocks have just blown bonds out of the water in terms of profitability. Since 1927, common stocks averaged 9.8% a year.
9.8, okay.
Compare that to Treasury bills, super safe government debt at 3.4%.
Big difference already.
Huge. And then you factor in inflation, maybe around 3% average.
Right. Eats away at your returns.
Exactly. So the real return, your actual increase in purchasing power, for stocks, it's still a healthy 6.8%. For T-bills, it's basically zero. No.
Wow. So after inflation, the safe T-bills didn't really make you any wealthier.
Pretty much. Your money kept pace, but didn't grow in real terms.
Let's put numbers on that. The Rip Van Winkle test you mentioned. $1,000 in 1927, sleep for 60 years.
Right. Wake up in 1987. If that $1,000 went into government bonds,
Or the safe bet.
the safe bet, you'd have $13,200. Not bad.
13,000. Okay.
But if that same $1,000 went into a basket of common stocks,
Let me guess.
more, a lot more. you'd wake up to $272,000.
272
Okay.
compared to 13. That's not even close.
Not even the same ballpark. And this massive difference, it forces you to really question what risk even means.
Yeah, it does.
Because the source material makes this really interesting point. Stocks are often called speculative, right? Risky.
Sure.
But the argument is that stocks are probably most accepted as being a prudent, sensible investment right at the moment when they're actually the least prudent, like at the top of a bubble.
Huh. So when everyone feels safe buying, that's when it's actually riskiest.
Kind of, yeah. It flips the script. Which brings us to maybe a better way to think about it. Not just volatility, but odds. Probability.
Okay, like poker. The source uses a poker analogy, 7-card stud.
Exactly. It's a great analogy because the best poker players, the ones who win consistently over years, they don't rely on luck.
Right, it's skill, calculation.
It's discipline, calculating odds, managing their bets, knowing when to fold, accepting small losses to avoid big ones. They manage the risk.
So the market isn't pure luck, and it isn't pure science either. It's about playing the odds you're given.
Precisely. And superior positions, better hands, better companies, they tend to win out over time. It's not guaranteed on any single hand or any single stock, but the probabilities favor the disciplined player.
And the data backs this up. Something about how many stocks beat the market.
Yeah, the analysis suggests something like 6 out of 10 stocks actually outperform the overall market average.
So picking winners is possible, but hard.
It is. But the key takeaway isn't just picking winners. It's about analyzing those odds, managing your risk, managing the downside. And that applies whether you're buying a supposedly safe bond or a risky stock.
So the danger isn't inherent in the name stock or bond.
Often, no. The real danger often comes from the investor's actions. Bad timing, buying high out of greed, selling low out of fear, not doing your homework. That's speculation. That's closer to gambling.
Discipline, then. That's the difference maker.
Discipline is fundamentally what separates calculated investing from hopeful gambling.
So what does this all boil down to for the listener?
Well, this deep dive suggests the line between investing and gambling. It's less about what specific thing you buy, the stock, the bond, and much more about how you buy it, your approach, your discipline.
If you're calculating odds, managing risk, thinking long-term, you're investing. If you're just chasing tips or hoping for a quick score.
That looks a lot more like gambling.
Okay. So a final thought for people to chew on.
Yeah, here's something to consider. If risk, as some argue, is really just the potential reward you get for accepting uncertainty, think about your own portfolio. How much of what you consider safe right now might actually just be an ill-timed investment waiting to underperform? And could something that feels risky today actually turn out to be the much safer, more rewarding bet over the long haul if you have the discipline to stick with it? It really challenges how we label things.
Welcome to the deep dive. Today, we're taking a bit of a different approach. We're not actually analyzing a stock.
No, not today. We're looking inward first.
Exactly. We're talking about what the sources call the mirror test. Basically, it's a checklist, right? 3 key personal things you have to sort out before you even think about buying.
That's it. And it's foundational. People often skip this, but honestly, your success probably depends more on these personal answers. You know, your stability, your timeline, your own head, than the fancy analysis.
The weak foundation makes the whole thing shaky.
Impossible, really. Good investing needs that solid base.
Okay, so let's lay out these 3 big questions. First, do I own a house? Second, do I need this money anytime soon? And third, maybe the toughest, do I actually have the personality for this? Let's dig into number 1. Owning a house. Why is that first?
Well, it's fascinating when you look at it. For most people, their house is pretty much the only good investment they consistently make.
Really? The sources say 99 out of 100 times it's a moneymaker.
Over the long haul, yes. And there are, like, structural reasons for that. It's not just dumb luck.
And this is where it gets interesting comparing it to stocks, especially around leverage and risk.
Oh, absolutely. With a house, you put down, say, 20%. That's significant leverage.
But here's the kicker, right? If the housing market dips and your house value goes down, the bank doesn't call you up demanding more cash.
Exactly. That's the crucial difference. Stocks bought on margin. Price drops, you get that margin call. You need more money now, or they sell your stock.
Ouch.
Yeah. A mortgage gives you leverage, but it's, let's say, safer leverage in that specific way. No forced selling based on market value dips. Plus, your home is a hedge against inflation. It's a good place to hunker down in a recession.
And kind of a forced savings plan, too, often government subsidized in subtle ways.
Right. But, and this is important, you still need to be smart about the house itself. It requires some real estate know-how.
You check in the basics.
Yeah.
Like, is the septic okay? Is the roof leaking? Drainage? All that stuff.
Precisely. If you mess up the due diligence on the property itself, you could wipe out years of potential gains with one huge repair bill. Be a decent real estate investor first.
Okay, that makes sense. Which leads us naturally to question 2. Do I need the money? We're shifting from something pretty illiquid, the house, to potentially very liquid stocks.
And that liquidity comes with risk, especially tied to time. So if you know you need these funds for something specific and soon, maybe college tuition in 2-3 years, or supporting an elderly parent.
And the advice is pretty blunt. Stay out of the stock market.
Unequivocal, yeah. Just don't do it.
It sounds like common sense, but what's the core reason? Is it just volatility?
It is. It's the volatility constraint. Even stocks that seem safe, big blue chips, they're still considered too risky if your time horizon is short, let's say under 5 years.
Because the price can drop.
And stay down. It can easily stay depressed for that entire 3 to 5 year window. You don't get to choose when you sell if you need the cash.
So you become a forced seller.
Exactly. And that guarantees you lock in a loss instead of just writing out what might be temporary paper volatility. Rule of thumb. Only invest money you could theoretically forget about for a decade without messing up your life plan.
That's a high bar. And it sets up the third question, which feels like the most personal. Do I have the personal qualities it takes?
And if you failed on 1 or 2, this one's almost impossible anyway.
Right. So what are these qualities? The list sounds, well, a bit boring, actually. Patience, self-reliance, common sense, tolerance for pain.
Humility, willingness to admit you messed up. It's not flashy stuff.
And the sources point out something surprising about IQ versus this temperament.
Yeah, the data's pretty clear. The really successful long-term investors, they aren't necessarily the super geniuses. Often their IQ isn't even in the top few percent.
So it's much more about managing your own emotions.
Overwhelmingly, it's about emotional discipline, not calculus.
Because your emotions, especially if you try to time the market, they just lead you astray, don't they? Buying high, selling low.
It's almost programmed. You feel concern when things are dropping, so you don't buy low. Then prices soar, you feel complacent, maybe FOMO, so you buy high.
And then the panic sets in. Capitulation. Selling right at the bottom.
Locking in the loss. It's a cycle.
Yeah.
And understanding this helps define what a true contrarian is.
It's not just shorting whatever's popular this week.
No, not really. The real contrarian, according to these sources, is the person acting when basically nobody cares. They're buying the forgotten stuff, the boring stuff, the assets Wall Street is ignoring.
Requires that patience and humility again. Buying when the market's almost asleep.
Exactly. So the big takeaway for you, the listener, your success probably leans much more heavily on how you answer these 3 personal questions passing that mirror test than on picking the perfect stock.
It all comes back to you, the investor.
Indeed. Maybe we should end with J. Paul Getty's formula for success. It's a bit tongue-in-cheek, but also quite honest about the effort and maybe luck involved.
What was it?
Rise early, work hard, strike oil. Okay, let's unpack this. We got some sources from a listener asking that classic question.
The is this a good market one, followed by please don't ask.
Exactly. So our mission today really is to dig into why these sources argue that predicting the market is, well, basically a fool's errand.
Yeah, and maybe find a smarter way to think about investing instead.
So let's start with the prediction problem itself. The sources really highlight the scale of failure here, right?
Absolutely. It's kind of stunning when you see it laid out. We're talking thousands of supposed experts.
Strategists, Fed watchers, gold bugs.
You name it. And they consistently fail to predict major market moves. Like that massive crash in '87.
They didn't see a 1,000-point drop coming.
Nope. Pretty much missed it. And get this, there are something like 60,000 economists in the U.S. trying to forecast things like recessions and interest rates.
60,000. Wow.
Yeah. And let's be honest, if they were actually good at predicting the future consistently, well, they probably wouldn't be drawing a salary, would they?
They'd be running their own massive funds, right? Okay, so the track record's poor. But why do we keep falling into this trap of listening to predictions? The sources mention a psychological element.
They do. It's fascinating, actually. They call it penultimate preparedness.
Penultimate preparedness. Okay, what does that mean exactly?
It means we're always preparing for the last crisis. not the next one.
Ah, like fighting the last war.
Precisely. The sources uses great analogy about the Mayans. They build higher after a flood.
Right. Makes sense. Prepare for another flood.
Yeah, but then they get wiped out by a fire.
Yeah.
They applied yesterday's solution, you see.
Got it. So, after the high inflation and crazy interest rates of the early 80s,
Everyone kept bracing for that again. Meanwhile, the market took off in a completely different direction. We're just fundamentally backward looking, it seems.
that backward view must feed into how crowds behave, too. There's that theory mentioned.
The cocktail party theory, yes. It maps out investor emotions during a market run-up. Kind of shows how the herd thinks, or rather feels.
Okay, walk us through the stages. Stage 1.
Stage 1, markets may be just starting to creep up. You go to a party, nobody's talking stocks, they're talking about, I don't know, their dentist or plaque removal, like the source says.
Inane stuff? Okay, stage 2.
Markets up a bit more.
Mm-hmm.
Maybe someone you just met quietly mentions they have, like an equity mutual fund. It's still pretty low-key.
Right. Then stage 3.
Now things are heating up. Market's up significantly, maybe 30%. Suddenly, everyone at the party is talking stocks, asking what you think about this or that.
Okay, I can picture that. So the final stage, stage 4, must be peak enthusiasm.
Exactly. That's when the crowd is practically surrounding you asking for hot tips, what to buy next.
And the sources say that's the point of maximum risk.
That's the signal, yeah. Because essentially all the skeptical money is already in the market. There aren't many new buyers left to push prices higher.
So the enthusiasm itself becomes the warning sign. No skeptics left.
Right. The market's vulnerable because everyone who might buy has bought.
Okay, so if predicting the market direction is basically futile and following the crowd is dangerous, what's the actionable strategy here?
Well, the sources are pretty direct. Stop trying to time the market. Stop betting on predictions.
Easier said than done, maybe. Wall Street certainly doesn't seem to follow that advice.
Oh no, Wall Street makes money from activity, from trading, right? But the advice for you is different. It boils down to this. Don't invest in the stock market, invest in companies.
Invest in companies, not the market. What's the distinction mean in practice?
It means focusing on the actual business. Is it profitable? Does it have good prospects? Is it maybe undervalued or just flying under Wall Street's radar?
Looking for solid businesses that maybe aren't popular yet.
Exactly. Finding value. Profitability, not popularity. Think fundamentals.
The sources bring up Warren Buffett here, don't they? That amazing Berkshire Hathaway example.
They do. Turning, what, $4,900 in the 60s into $1.4 million today or something like that?
Incredible. A 700 bagger, they called it.
Yeah, and the point is that came from finding a good business, understanding it, and then just holding on, ignoring all the short-term market noise, letting the company grow, and letting compounding work its magic over decades.
Right. So let's distill this. Key takeaways for you listening. First, don't put too much faith in professional forecasters.
Definitely. And ignore the day-to-day, even month-to-month market swings. It's mostly noise.
Look for good companies, maybe ones Wall Street hasn't discovered yet. Understand the business.
And remember that over the long haul, the returns from owning parts of good businesses, stocks, have historically been much better than, say, long-term bonds. It's fairly predictable in the long run.
So fundamentally, it's about shifting focus from the impossible game of prediction
To the achievable task of identifying value. And here's maybe a final thought to chew on, something the sources hint at.
Okay.
You, the average person, often encounter interesting local companies or new products years, literally years, before Wall Street analysts even hear about them.
Huh. So use your own observations.
Could be an edge. It ties back to the main idea. Focus on what you can understand, the tangible business. As the saying goes, or as the source puts it, in the stock market, 1 in the hand is worth 10 in the bush. Focus on the real value you hold. Welcome to the deep dive. Today we're tackling maybe the ultimate investment shortcut. How do you spot a 10-bagger? You know, a stock that goes up tenfold. Not from dense reports, but just by looking around you.
That's really the heart of it. The biggest wins are often right under our noses, things Wall Street overlooks until it's way too late.
Okay, like what kind of things?
Well, think about the early days. Dunkin' Donuts, McDonald's, Pep Boys even. Thousands, literally thousands of local customers saw that explosive growth happening long before the big finance folks paid attention.
Right, right. So this local edge.
Yeah.
It sounds like you don't need the fancy degree, just better observation skills day to day.
Exactly.
But how do you tell, a passing fad from something real, something with that 10 times potential?
It comes down to observing the fundamentals, the physical reality. I mean, the sources point to loads of examples where regular jobs gave people the edge?
Not just the CEO finding the next big thing.
No, not at all. For Pep Boys, it wasn't just the execs. It was the painters seeing more stores go up, the clerks handling more customers, the cement suppliers pouring more foundations. They saw the demand physically soaring. That's tangible.
Yeah, tangible data. I like
Eh.
that filter. And it's not just retail, is it? The sources mention a wedding photographer.
Uh-huh. Saw high-quality 35mm cameras making a comeback, a real challenge to Kodak's dominance back then. That insight came directly from his job.
Or the school teacher noticing some new gadget,
Yeah.
a gizmo,
Oh.
suddenly everywhere among students.
Exactly. Immediate professional experience giving you the heads up.
Okay, so this local knowledge can scale up to specialized industry insight, which brings us to the ulcer drug case study.
Yeah, Tegamet, SmithKline-Beckman's huge drug from
It's
'76.
a game changer, medically speaking.
Massive breakthrough. But who really had the investment insight? Often it wasn't the doctor prescribing it, it was the pharmacist.
Pharmacist, how so?
Well, one pharmacist mentioned in the research basically spent half his workday just filling Tagamet prescriptions. The sheer volume, the demand was relentless.
Wow.
That practical, on-the-ground view, it let people see Tagamet go from, $7.50 a share in '77 to over $70 by '87.
Okay, but hold on. Why would the doctor prescribing it maybe miss that while the pharmacist caught it? Isn't that kind of a double-edged sword, that expertise?
It is, but it's about applying your own specific expertise. The doctor's focused on the patient outcome, maybe not the stock potential. The oil exec probably sticks to oil stocks, right?
Right. Tunnel vision sometime.
The pharmacist's job was directly tied to volume. So the rule is, use your professional knowledge to spot a major shift or imbalance in your own field.
Okay, that makes sense. And that
Yeah.
applies directly to spotting turnarounds, especially in cyclical industries.
Absolutely. Take the vinyl chloride example. You've got a worker in that industry. They see demand is up, prices are climbing, and crucially, they know no new factories are being built.
So they know supply is capped.
Exactly. Rising demand, fixed supply. That worker knows profits for existing companies are about to soar long before any analyst crunching numbers figures it out. They see the lack of construction.
It's information asymmetry based on just being there.
Precisely. Or think about a Goodyear tire store owner. After 3 slow years, suddenly, bang, big surge in orders.
They've got front row seats.
Front row seats to a huge Goodyear turnaround months before it makes the financial news.
And this isn't ancient history either. The mutual fund boom in the early 80s. Dreyfus.
Oh, yeah. Dreyfus was incredible. From 40 cents a share to $40, that's a 100-bagger.
100 times. Who saw that coming?
Insiders.
Yeah.
People working within the industry. They didn't just see fund sales reports. They saw the operational reality of that explosion.
So not just the sales numbers, but the growing pains.
Yes. They saw maintenance services expanding like crazy in the offices, sales teams running ragged across the country. They saw the infrastructure straining to keep up, that physical scaling, that visible sign of exponential growth. Wall Street only saw it later in quarterly earnings.
Okay, so wrapping this up, what's the core takeaway for our listeners?
It's pretty straightforward, really. Your most valuable investment insights might just come from understanding and, crucially, applying what you see and experience in your own job, your own life.
It gives you that observational edge.
A huge edge over just relying on standard financial reports that everyone else is reading. The truth is often hiding in plain sight.
Yeah, embedded in your daily routine.
Yeah.
So here's something to think about. What hidden gem, what overlooked turnaround might be unfolding right now in the supply chains you deal with, the stores you visit, the services you use every single day?
What change is happening in your world that maybe Wall Street hasn't noticed yet?
That's where you start looking for your next 10-bagger.
Welcome to the Deep Dive. Today, our mission really is to give you a solid framework.
Yeah, a way to think about stocks so you don't just jump on the next tip.
Exactly. Forget Uncle Harry says buy this. We need to build a real story for any stock you're thinking about putting money into.
Because, honestly, investing without doing that homework, it's like playing poker and deciding not to look at your cards.
Right? It makes no sense. We have to fight what our sources call the Charmin syndrome.
Yeah, where you spend ages picking the right toilet paper.
But then you'll just throw like 10 grand at a stock because someone mentioned it. No annual report, nothing.
That focus needs to shift completely. It's all about what actually moves the needle for the company's earnings.
Like, remember Johnson & Johnson back in '88? The stock popped, what, $8 almost overnight?
And it wasn't just about the Retin-A cream itself.
No. It was the idea that it could fight sun damage. and what that meant for future profits, that immediate expectation.
So the question becomes, how do you get organized with this research? How do you avoid treating, say, a utility company like some hot tech startup?
There's a system?
There is. We've basically boiled down all the useful ways to think about stocks into 6 main categories. It simplifies things.
Okay, let's break them down. Where do we start?
Let's start simple. Category 1, slow growers. These are usually, large, pretty mature companies.
Okay.
They're expanding, but maybe only about as fast as the overall economy. Think like 3% year growth.
So not setting the world on fire.
Definitely not. They often pay decent dividends, which is nice, but you're not looking for huge price jumps. Think about electric utilities, maybe back in the 50s or 60s.
Yeah.
Used to be growth stars, now just steady.
All right, steady but slow. What's next up the ladder?
Then you've got the stalwarts. These are also huge companies. Think Procter & Gamble, Coca-Cola, Bristol-Myers.
Well, hold names.
Exactly. They offer more growth than the flow growers, but it's moderate, consistent, maybe aiming for like 10 to 12% earnings growth each year.
And these are pretty reliable.
Generally, yes. They're not usually the stocks that go up tenfold the 10-baggers, but they hold up well in rough patches. Bristol-Myers, for instance, did relatively okay during that nasty 73-74 market crash.
So why is that? What gives them that stability, that 10-12% when things get rocky?
It's often brand power, market dominance. People still buy their soap, their soda, their medicine, even in a recession. They've got a moat.
Okay, that makes sense. So below them, or rather faster than them.
Right. You get the fast growers. These tend to be smaller, newer, much more aggressive companies.
Oh, it's the exciting ones.
They can be. They're shooting for maybe 20-25% growth per year. This is where you can find those life-changing investments, the next Walmart or Taco Bell if you get in early.
But there's a catch, right? High growth must mean higher risk.
Huge catch. They're risky. If they run out of expansion room or competition heats up or they just kind of lose steam, they can fall fast and hard.
Okay, so high reward, high risk. Got it. What's the fourth category?
Cyclicals. Think car companies like Ford, airlines, chemicals, steel.
Stuff that depends on the economy doing well.
Precisely. Their sales and profits go up and down in cycles, tied directly to whether the economy is booming or busting.
So timing is key here.
Timing is everything. You can lose half your investment, maybe more, incredibly quickly if you buy a cyclical right before things turn down. Very treacherous if you misjudge the cycle.
Wow, okay. So those are the 4 main types based on growth and economic sensitivity. What about the others? You mentioned specialty categories.
Yeah, the last 2 are a bit different. The research involved feels less like forecasting sales and more like, detective work.
Intriguing. What's number 5?
Turnarounds. These are companies that have been really beaten down. Maybe they're former cyclicals that got hammered, or they just made some big mistakes. They're depressed.
But there's hope for a comeback.
That's the idea. You're betting on a major recovery, maybe because of new management, restructuring, something changing internally.
Like Chrysler back in the day.
Exactly.
Yeah.
That stock went up, 5 times in under 5 years from its low point. Huge potential. But the risk is also massive. Many turnarounds don't turn around.
So how do you even research these? It can't just be hoping the economy picks up.
No, you have to dig into the company's financials, look at the balance sheet. Are they selling off unprofitable divisions? Are they paying down that crippling debt? You need evidence of internal healing.
Real internal change. Okay. And the final category, number 6.
This one's called asset plays. It's a bit unique.
Yeah.
Here, the company owns something valuable, maybe real estate, oil reserves, patents, even TV stations that the market isn't fully recognizing.
So the stock price doesn't reflect what the company actually owns.
Correct. The value of the underlying assets, if sold off piece by piece, might be much higher than the stock market valuation implies.
How do you find that? That seems hidden.
It often is. You need to go beyond the standard earnings reports. Look at SEC filings, dig into property schedules, check for non-operational holdings. What real estate do they actually own? What are the mineral rights worth? The classic example is Pebble Beach being sold to 20th Century Fox. The land value was way more than the company's stock price suggested.
Ah, I see. So it really requires knowing what they own, not just what they sell.
Exactly. It's about the hidden value on the balance sheet.
Okay, so slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. That covers a lot of ground.
It covers pretty much everything an investor needs to distinguish between.
And the main takeaway here seems to be that you absolutely cannot treat them all the same.
Absolutely not. Trying to apply some generic rule like always sell a stock after 2 years is just, it's complete folly.
Yeah.
A stalwart strategy is totally different from a cyclical strategy or an asset play strategy.
You need to know the story before you invest. Understand which category it fits into.
That's the whole goal. Know the story.
Right. So let's leave our listeners with a thought. For asset plays, you mentioned looking at non-operational holdings like land or mineral rights, but what specific detail beyond just knowing they have those rights is absolutely critical for figuring out their true hidden value, especially with something like oil?
Yeah, good question. It's not enough to know there might be oil. You need to know the proven reserves. How much oil is actually confirmed to be there, certified by independent engineers. That's the number that matters. That's the detective work.
Proven reserves. Got it. That makes the difference. Thanks for diving deep with us today.
Welcome to the Deep Dive. Today, we're trying to shortcut the path to finding what you might call the perfect stock.
Right. And we're using some interesting source material here, focusing on, let's say, less obvious characteristics.
Definitely counterintuitive stuff. Forget the flashy tech giants for a minute. We're looking at companies that are maybe overlooked.
We are definitely looking where Wall Street isn't. The whole strategy is about finding that fundamental, solid value that the big analysts and institutions just tend to ignore.
Yeah, if everyone's talking about it, you're probably too late.
Exactly.
And a core idea from our sources, which I love, is simplicity. The best companies, so simple, the saying goes, an idiot could run the business.
Yeah. That sounds harsh, but it means the business model itself is robust. It's not reliant on, some genius CEO making miracle moves every quarter.
A great simple business is better than a complex one run by a star manager. That's the takeaway.
And that leads straight into what the sources call the anti-glamour strategy. You actually want names and products that are, well, dull, designed to put those big investors right to sleep.
Right. Dull names are a feature, not a bug. Like Pep Boys Manny, Mo, and Jack. It sounds ridiculous.
Yeah, not ridiculous.
Compared to something sleek like, I don't know, Gene Splice International.
Yeah.
But Pep Boys might be the stronger prospect hidden behind the silly name. Gene Splice gets the headlines, maybe, but
the fundamentals might be shaky. And if the name's dull, the business itself ideally should be a bit disagreeable.
disagreeable. You mean like unpleasant?
Yeah, exactly. Think essential but unattractive. The sources mention safety clean.
Oh, right. They clean sludge from gas stations, automotive parts washers, that kind of stuff.
Nasty work, but absolutely essential. And because it's not glamorous, you get way less competition. Analysts aren't exactly lining up to cover the sludge industry.
Which means it often fits that simplicity principle too, right?
Yeah.
The process is basic, necessary.
Spot on. Now, if it's not disagreeable, maybe it's just in a no-growth industry.
Which sounds bad initially, no growth. But the sources argue that often means stability.
Exactly. Take the funeral business, not exactly a high-growth sector, thankfully. But look at Service Corporation International, SCI. They've spent years just buying up local funeral homes.
And now they own, what is it, over half the market in the U.S.?
Something like that.
Yeah.
Massive dominance in a field that is, well, incredibly stable. People keep needing their services.
So dull names, disagreeable businesses, or stable, no-growth niches.
Yeah.
It's all about avoiding the crowd.
Precisely. Which brings us to strategic isolation, finding companies that are ignored structurally.
Like spin-offs.
Exactly. When a big company spins off a division into a separate entity, that new company is often misunderstood or just dumped.
Yeah, the parent company might just want it off the books fast. Sometimes they even give the shares to their own stockholders as a dividend who then don't know what to do with this odd little company.
And they sell it, depressing the price. But there's opportunity there.
There's that amazing example of the baby bells, right? After the AT&T breakup in '83.
Oh, yeah, fantastic case. Those 7 regional companies. What was the return?
Between '83 and '88, the average gain, including the dividends, was something like 170%.
Yeah.
Absolutely crushed the market index.
See? Ignored maybe confusing structure, but fundamentally solid businesses.
So who shouldn't own these perfect stocks then, if Wall Street's ignoring them?
Institutions. You ideally want low institutional ownership. Analysts shouldn't be following it closely.
Okay.
Instead, you look for one key thing. Insiders buying the stock. The managers, the executives.
Right, because they know the business better than anyone if they're putting their own money in.
It's a huge vote of confidence. They think the shares are cheap compared to the company's real value. It's not just talk. It's their cash on the line.
Makes perfect sense.
Yeah.
Okay, what else? There's one more big piece in these sources.
The financial secret weapon, you could call it. The buyback. Stock buybacks.
Ah, yes. Where the company buys its own shares on the open market.
Right. And it sounds simple, but it's powerful. They buy the shares and usually they retire them. They just disappear.
So the total number of shares floating around shrinks.
Exactly. And think about earnings per share, the EPS. That's the company's total profit divided by the number of shares.
So if the profit stays the same, but the number of shares goes down.
Your EPS automatically goes up, even if the business itself hasn't grown an inch. It's kind of magical for shareholders.
And companies do this strategically. Exxon, for instance, sometimes buying back stock is cheaper for them than drilling for new oil.
It's an efficient way to return value. And Chrysler, during their big turnaround, used buybacks really effectively. It was a huge part of their stock's great performance.
So wrapping this all up, it seems the path to finding these potentially great stocks isn't about chasing hype.
Not at all. It's about looking for simplicity, for stability, maybe even for things that are a bit boring or off-putting. Being a contrarian.
Find the value where others aren't even looking.
Precisely. So here's something for you to think about after this deep dive, building on this. Given that the best businesses are often dull or disagreeable or in these stable niches, what essential product or service out there is just reliably boring? Something people have to keep buying almost no matter what the economy's doing. Think plastic knives maybe, or certain soft drinks, or like SCI, grape plots.
Stuff that's just always needed.
Yeah. What's so essential, it flies under the radar. That overlooked niche might just hold your next deep dive target. Okay, so we've got this stack of material here, and it's really all about helping you, the listener, spot some of the big pitfalls in the stock market. Avoid them, really. This deep dive isn't about, recessions or anything macro. It's strictly about behavioral danger signs, human stuff.
Exactly. And what's really interesting is the warnings aren't about specific industries, not really. It's about us, how we behave.
Yeah.
Chasing the hype, maybe ignoring the fundamentals, confusing all that activity with actual progress. So our mission today, essentially, is to quickly flag 3 major types of stocks that the sources strongly suggest avoiding.
All right, let's jump in. Trap number 1, the hottest stock. The sources are pretty blunt here. That company getting all the buzz, the one everyone's talking about, often that's the one to actually avoid. There's this social pressure, right? It pushes you to buy.
Right.
And then it makes it really hard to sell, even when, well, logic says you should.
Yeah, we have a perfect example. Remember Home Shopping Network, HSN. In just 16 months, the price went from $3 to a peak of $47 that's adjusted for splits. Then boom, back down to $3.50. And the analysts, they were predicting huge growth, double digits, but they were completely ignoring the balance sheet, which was, frankly, deteriorating fast. And they missed that really simple question the source brings up. Seriously, how many zirconium necklaces can people actually wear?
It's funny, but it's true. It's that common sense thing we forget. If everyone's buying, maybe think twice. The sizzle just leads to a fizzle. It happens because that super fast growth, it attracts a crowd, imitators jump in, and then competition just erodes the profits. We've seen it before, right?
Yeah.
Mobile homes, digital watches.
Oh, yeah. Wall-to-wall carpeting, disk drives, the list goes on. High growth pulls in competition like moths to a flame. And those profit margins disappear quicker than the company can adapt.
Okay, so that's the individual investor getting caught up in hype. What about the companies themselves?
Right. So if we shift focus from, let's say, investor hype to corporate hubris, we hit trap number 2, diversification. Sometimes companies use cash. Well, buybacks, dividends, sensible stuff. But other times, they waste it. They go on these acquisition sprees, buying stuff that's way outside their actual expertise, value-destroying moves.
Wait, but isn't that just diversification, trying to spread the risk? What makes this kind so bad? They call it diversification.
It's the kind of diversification. Often it's about ego, not strategy. The CEO wants to build an empire, maybe. So they buy totally unrelated businesses they don't really understand. Look at the contrast the source gives us. Melville versus Genesco. Melville did great. Why? They stuck close to home. Shoes, then related retail like CVS, Marshalls, made sense. Genesco, oh boy, between 1956 and 1973, they made 150 acquisitions. Unrelated stuff. Manufacturing, department stores, all over the map.
And I'm guessing Genesco's numbers didn't look too good after that.
Not at all. Their fundamentals tanked. They kept talking about synergy, that buzzword.
Right, the whole 2 + 2 = 5 idea.
Exactly. But it never happened. The acquisitions just dragged down profitability. Meanwhile, Melville, focused, stuck to its knitting, grew 30-fold by 1987. Focus really pays off, it seems.
Okay, so avoid the hype stocks, reject the bad acquisitions.
Hmm.
What's left? The speculative plays. Trap 3, the whisper stock. These are the long shots, right? Built more on a story, an emotional appeal, like maybe they'll cure a major disease or find some energy breakthrough. Huge potential, but often little or no actual earnings.
Yeah, hope is basically the main asset, which, isn't a business plan. There's that classic anecdote about bioresponse. They used all this complex jargon in their press releases.
Yeah.
Amorphous silicon photovoltaics, video multiplexer.
Mm-hmm.
Sounded impressive, but what were they really working on? A low-cost way to get cow lymph from mice for insulin production. The stock climbed on the, let's call it the whisper and the hope. Went from about $9.75 to $16, but eventually it was sold off at a small loss. Just didn't pan out. And look, when a company has no earnings, the PE ratio is meaningless, right? Infinite, maybe. So your investment is pure speculation, guesswork, not based on anything solid you can measure.
Right. So let's recap quickly. We've covered avoiding that hot stock hype that inevitably burns out. We talked about rejecting those disastrous, often ego-driven corporate acquisitions, the diversification, and steering clear of those purely speculative whisper stocks that run on hope instead of earnings.
Yeah, the core lesson seems pretty clear. Successful investing, long-term at least, tends to favor companies that have, what, respectability, decent earnings, business models you can actually understand. Often they're the dull ones, reliable performers.
You know, the source material makes this interesting point about Xerox. Maybe if its name hadn't sounded so, well, dull, maybe early buyers would have been more skeptical of its actual solid fundamentals. It raises a funny question for you to think about. Is a boring stock name actually better? A better sign than one that sounds super advanced or exciting? Something to ponder next time a company you follow decides to change its name to sound, trendy.
Welcome to the Deep Dive. Today, we're tackling probably the most fundamental question there is for investors. What actually makes a stock valuable? Why does the price go up? Our mission today is a focused deep dive into what really drives value. Think, earnings, earnings, earnings.
Yeah, and it's so important to start with the basics here. A share of stock isn't some lottery ticket, right? You're buying part ownership in a real business. Ultimately, its value, its real worth is tied to its assets and, crucially, its power to generate earnings. Prices might drift, but they always tend to gravitate back towards that underlying value.
Okay, so let's unpack that. If earnings are the key, then the best shortcut for you, the listener, to gauge that value is figuring out the link between earnings and the stock price itself.
Exactly. And that link is usually measured by the PE ratio, price to earnings multiple. Think of it as sort of the market's expectation gauge. It tells you basically how many years of current earnings it would take to pay back the stock price you paid. Assuming, of course, earnings stay flat, which they rarely do, like take Kmart back in the day. If the stock was $35 and earnings per share were $3.50, well, that's a PE of 10. Simple division.
Right, 10 years to pay back the price. But here's where I always get a bit stuck. PE uses past earnings, right?
Yeah.
$3.50 was what they already earned. Investors only care about the future. So how useful is a backward-looking number?
That's the million-dollar question, isn't it? While the E part, the earnings, is historical, the P part, the price, reflects what the market thinks will happen next. The multiple itself is forward-looking, and historically you see this strong connection. Look at, say, Marriott or the Limited in the mid-'80s. Their earnings absolutely soared. And guess what? Their stock prices went right up with them. Lockstep, almost. High expectations mean a higher PE multiple gets assigned. You see this difference clearly between types of companies. Slow, steady growers, maybe like utility companies, they tend to have lower PEs. Predictable, but maybe not exciting growth. But then you have the fast growers, the disruptors, like Sensormatic back then. That stock went from $2 to $42. Those companies get much higher PEs because investors are betting big on future growth.
Okay, so that's where the danger comes in, right?
Yeah.
When does that PE ratio flash red? It sounds like it's when investors are making huge bets on future earnings. Thoughts that might just be, well, unrealistic.
Precisely. And it's fascinating and frankly a bit scary how quickly those unrealistic expectations baked into a high PE can just demolish value, even for good companies. Think about Avon Products back in 1973. Its PE got pushed all the way up to 64. 64.
Oh, 64 times earnings.
Yeah. And when earnings just dipped slightly, didn't even collapse, just dipped. The market panicked. The stock price fell 86% in under a year.
So it wasn't just the earnings miss. It was the market saying, whoa, we paid way too much for those earnings in the first place.
Right.
The multiple collapse.
Exactly right. The multiple contraction was brutal. And Polaroid, same story, same year. Huge hype around their new SX70 camera pushed the PE to 50. When the reality didn't match the hype, boom, stopped down 89% in about 18 months. And then there's the really extreme example, EDS in the 60s. It hit a PE of 500. 500. One analyst at the time apparently even suggested 1,000 was possible. Just pure fantasy pricing.
So the big takeaway for you listening is the PE matters immensely because even solid companies can absolutely crumble if their stock price is built on fantasy instead of, fact-based earnings potential. So if getting the price wrong crushes value, your only real defense is knowing how a company actually plans to grow those earnings sustainably. What are the real ways they do it?
Right, because predicting the future, exactly, that's tough, maybe impossible. So your analysis has to shift to the how. How does the company plan to increase earnings? And there are basically 5 ways companies do that. 1, raise prices. 2, cut costs. 3, expand, find new markets. 4, sell more stuff in their existing markets. Or 5, fix or just get rid of operations that are losing money.
Okay, those 5 paths. And knowing this gives you an edge, right? Because raising prices, well, that's often temporary. Cutting costs. You eventually hit bone. So the really big growth potential, the stuff that justifies a higher PE maybe, often comes from expanding into new territory or successfully launching something totally new. But that's also riskier.
That's the core of it. Your research needs to dig into which of those 5 levers the company is pulling or plans to pull. Which one is really behind the market's optimism reflected in that PE?
So that leaves you with a really important question to chew on. If you know you can't perfectly predict the future earnings number, which of these 5 growth strategies, the safer, maybe slower ones, or the big, risky, game-changing ones, would make you feel comfortable paying a premium PE for a stock today? Think about that growth plan as you do your own digging.
Welcome to the deep dive. Our mission, really, is taking often complex financial analysis and boiling down, making it immediate, actionable knowledge for you.
Right, skipping the jargon.
Exactly. We want to get straight to the core insight.
And that core insight often comes down to what, some call the 2-minute drill.
Okay.
Basically this. Can you deliver a concise, super simple script or story about a stock?
Simple how?
So simple that, say, a smart kid could get the gist of the situation. Honestly, if the story isn't that clear, maybe you don't fully grasp the investment yourself. The better the story, the shorter it is, usually.
That makes sense. Simplicity as a sign of understanding, but it can't just be any simple story, right? What needs to be in this script?
Good point. It's got to cover 3 key things. Why are you even interested? What's the path to success look like? And crucially, what are the big risks, the pitfalls?
Reasons, path, pitfalls. Got it. So this simplicity actually requires some real thought beforehand.
Absolutely. And when you're crafting this drill, remember, companies usually fit into like one of 6 basic narratives.
6. Okay, what are they?
You know the types. Slow grower, stalwart, cyclical, turnaround, fast grower, or maybe an asset play. Your 2-minute monologue needs to match that specific type of story.
Okay, let's make that concrete. How does the actual story change, say, for a cyclical company?
Right, for a cyclical, the script often highlights the turn. Maybe the business slump is ending. You'd note specific things like costs were slashed by 20% during the downturn, and now finally sales are ticking up. That's the plot.
Simple and focused.
Or think about a turnaround. General Mills is a classic example mentioned in the sources.
Okay.
The script there isn't vague. It highlights specifics, selling off assets that don't fit, like Eddie Bauer or Talbot's.
Right, cleaning house.
And then, importantly, using that cash for something like a huge share buyback. In their case, I think is, 7% of the market cap? That's a concrete narrative.
Yeah, you can picture that. And a stalwart like Coca-Cola. What's their story? It's not a turnaround.
No, definitely not. For a stalwart, it's often about a reliable, maybe even boring growth. But the script finds the compelling part. For Coke, it was the phenomenal foreign success.
Ah, international growth.
Exactly.
Yeah.
Like that specific detail about Japanese consumption jumping 36% in 1 year. That single number tells a powerful story about their global reach.
Okay, let's shift gears. Let's apply this drill to a success story. La Quinta. The sources flag it as a fast grower. What was their unique angle?
La Quinta's niche was brilliant, really. They offered something that felt like Holiday Inn quality.
Okay, so decent lodging.
Right, but they could charge about 30% less.
30%? How on earth did they manage that? That seems like a huge gap.
Well, they knew their customer inside out. Business travelers, government people, hospital workers on the road. Predictable.
Very. And they realized these people didn't really need or want expensive extras, so they just cut them out.
Cut what exactly?
No big conference rooms, no wedding ballrooms, no full-service kitchens or restaurants.
Ah, the high-cost stuff. Precisely. And they kept construction simple, too. No sprawling, complex buildings, just efficient, repeatable designs. The focus was pure. Basic luxury, convenience, value.
So the stop was a bargain because the story was so clear.
A screaming bargain, yeah. Trading at like 10 times earnings, even when some insiders were selling lower. The narrative was just that strong, that understandable.
Okay, let's contrast that with a failure. Bildner's, the specialty food store. What went wrong there? The script failed.
Bildner's is such a cautionary tale. A great concept initially, but they tried this massive expansion, new stores in Boston and Atlanta, funded it with debt and a public offering.
Okay, ambition.
Yeah, but they hit a fatal flaw. It wasn't the food or the store design.
What was it then?
Management. They just didn't have enough skilled store managers to run all these new locations effectively.
Yeah.
And they lacked the financial cushion to handle the inevitable hiccups during expansion.
So it wasn't the idea, it was the execution, the scaling.
Exactly. The big takeaway here, and the sources are really clear on this, is never invest until the company proves the prototype works elsewhere.
You mean not just in its home market?
Right. You shouldn't be sitting there wondering, okay, great in Boston, but will this actually work in Chicago or Miami? They hadn't proven that replicability.
Result.
Disaster. The stock went from $13 down to like pennies, 58 I think it was, just collapsed.
Wow. Okay.
So circling back, the whole point of this 2-minute drill isn't about gathering endless data. It's about forcing yourself to get that clear, simple understanding. What's the story? What could go wrong?
Yeah, it seems the difference between Lacuna's success and Bildner's failure really came down to that simple, well-understood story. And maybe not making assumptions about smooth sailing during growth.
Which kind of makes you wonder, doesn't it?
How so?
Well, we demand this simple, clear script for our investments, right? Reasons, path, pitfalls. But how often do we apply that same rigor, that same 2-minute drill to our other big decisions? Like, do you have that script for your career path? Or your next major life change?
That's actually a really good question.
Just something for you to think about. Welcome. So, we often just sort of passively take financial advice, right?
Yeah.
Broker says buy Zaire maybe, and you just go, okay, sounds fine, let's do it. Today, we're focusing on building a proper firewall against that, the mission.
Yeah.
To shift you from just, accepting advice to being a really critical, active investor.
Yeah, and it's a big mental shift, isn't it? It's moving away from hearing special situation and just nodding along.
Right.
Instead, you start demanding the actual data. You want to see the thesis, the proof behind it. That reliance on data, that's where portfolio strength really comes from.
Okay, so let's dig into this. We've got this great example from the source material. La Quinta Motor Inns. Broker calls you up, recommends La Quinta. What's the very first thing?
Classification. Absolutely. You need to ask them point blank, okay, what kind of stock is this? Is it cyclical? A slow grower?
Or are they pitching it as a fast grower?
Exactly. And let's say they do say fast grower. That's your cue.
Okay, so what then?
Then you hit them with the metrics. Okay, what's the recent earnings growth? And crucially, the PE ratio. Where is it right now compared to its own history?
Not just the number, but the context.
Precisely. Because if the PE is already high historically, maybe the market's already figured this out. The growth might already be priced in.
Meaning the broker could be, a bit late to the party.
Could be. Which brings you to the next hurdle, strategy. The why now question.
Right. What makes it a good buy today? Where's the actual business growth coming from? New locations.
Are the existing places actually making money? Or is it all just expansion hopes?
Good point. And tied to that is the money side, isn't it?
Absolutely. You have to ask about the debt. What's the balance sheet look like?
And crucially, how are they funding this growth?
Yes. Are they going to sell a ton of new stock? Because that dilutes your earnings per share.
Dilution, yeah. Nobody wants that sneaking up on them.
And are they insiders putting their money where their mouth is? Are they buying shares too? Or just telling you to buy?
Important signals. Okay, so you've asked these big picture questions. What's next? You can't just take their answers at face value, can you?
No way. This is maybe the most critical part. Get the source material.
The actual analyst report.
The full report, not their 2-sentence summary. You need to see the reasoning, the data they used.
And what else should you be looking for in or alongside that report?
You need history. A chart, maybe 5 years back, showing the stock price plotted against the earnings. Does the price follow the fundamentals?
Okay, proof that it's not just hype.
Right. And dividends. If they pay them, have they been consistent? Always paid.
What about market confidence?
Good one. Ask what percentage of the shares institutions own. Big funds doing their homework and buying in, that's usually a positive sign.
Suggests deeper conviction.
It can, yeah.
Yep.
And also, vet the analyst. How long has this specific analyst at that firm actually been covering this stock? Years. Or did they just pick it up?
Depth of knowledge versus a quick take.
Yeah,
Makes sense.
yeah.
So you've gathered all this info, read the report.
Now comes the power move.
Which is?
The power of delay. Resisting the pressure.
Because the broker's going to be saying,
Don't wait. Now's the time. It's taking off. All that urgency.
yeah, the classic FOMO push.
Exactly. But your response needs to be calm, measured. Thanks, I'll take a look. I need to read this report first.
Maybe check the debt details.
Perhaps even call the company's investor relations. You hold the cards until you're satisfied.
So wrapping this up, the main takeaway here is that real due diligence isn't just listening. It's actively vetting.
It's a process of elimination, almost. You check the growth story, you check the finances, the history, the market sentiment before you commit. Don't let urgency cloud your judgment.
It's about caution, isn't it? Even when everything seems perfect. Which reminds me of that great Mark Twain quote about speculating in stocks.
Oh, which one?
He said, October is one of the peculiarly dangerous months to speculate in stocks.
Okay.
The others are July, January, September, April, November, May, March, June, December, August, and February.
Right. Basically, always be careful.
Exactly. Something for you to think about. Welcome to the Deep Dive. Today, we're kind of going on a scavenger hunt right into the heart of corporate finance.
Yeah, that's a good way to think about it.
Because if you, like a lot of analysts, look at a company and the first thing you see is the share price, maybe the PE ratio, you might be missing some really crucial stuff.
You definitely are. Those headline numbers, they often hide more than they reveal. They're these invisible layers of corporate worth just, buried in the balance sheet.
Exactly. So that's our mission for this deep dive. We want to help you uncover the real value. We're focusing on two key ideas.
Right. We find that these complex financial documents, sometimes they seem designed to obscure the simple truths, don't they?
They really do. So we want to distill what actually matters for figuring out first the immediate risk, kind of a safety buffer. We call that the cash position.
Liquidity.
And second, the sort of longer-term potential that's often hidden away. Hidden assets.
Yeah.
These two things together, they give you a much clearer picture of a company's foundation.
Yeah, because you have to look beyond just revenue, right? Sales are important, sure, but stability. That comes from the cash cushion, specifically net cash, and those assets that maybe aren't obvious at first glance.
Okay, so let's start with that safety cushion, the cash position.
Good place to start. It tells you about immediate survival potential.
And when we say cash position, we're not just talking about, like, the cash listed on the top line. It's more specific, isn't it?
It is. It's the cash after you account for all the long-term debt. It's the money that's truly free and clear, ready to use if things get tough or, if a great opportunity pops up.
Got it. Net of long-term debt. And there's a classic example of Wall Street completely missing this, right? Ford Motor Company.
Oh, Ford in the mid-'80s is perfect.
Oh, yeah.
It really shows how the market can get swept up in a story. In this case, the whole auto industry is cyclical story and just ignore the hard numbers on the balance sheet.
So what was happening? Ford stock had been on a tear.
A huge run. Yeah, it went from maybe $4 a share back in '82 up to around $38 by early 1988. A massive increase.
Okay, $38. For an auto company known for its ups and downs, that probably looked pretty expensive to people.
It did. And the analysts, well, they were almost universally bearish. They were completely focused on the cycle. They saw that price, $38, and basically said, okay, this is it. This has got to be the peak before the next downturn hits.
They saw the historical pattern, the price, and just stopped looking.
Pretty much. They completely overlooked what was sitting right there on the balance sheet, the crucial detail.
Which was?
The cash. Ford had piled up an absolutely enormous amount of cash, net of all their long-term debt. We're talking $16.30 per share.
Wow. $16.30 per share. Just sitting there.
Sitting there. So think about it. The market's trading the stock at $38.
But almost half of that price wasn't really for the car business at all. It was just cash you were getting back immediately.
Exactly. That's the key adjustment. When you bought Ford at $38, you were inheriting $16.30 in net cash. So the price you were really paying for the actual auto operations, the factories, the brand, everything else, was much lower.
Okay, let's do the math. $38 stock price, minus that $16.30 in cash.
Gets you to $21.70 per share. That's the effective price for the core business. That cash buffer was massive and totally ignored.
And this is where the valuation story completely flips, I assume. What were the earnings expectations?
Right, so Ford's auto business was expected to earn about $7 per share that year. Now, if you use the market price, $38 divided by $7 earnings, the PE isn't that exciting, maybe a bit high for a cyclical company back then.
Okay. But if you use the real price?
The $21.70 you were actually paying for that earning power, you take $21.70 divided by $7 earnings.
And you get a price-to-earnings ratio of just over 3, like 3.1.
3.1. I mean, in 1988, getting a company like Ford, a giant quality American company, at a PE of 3.1 for its core operations, that wasn't just cheap, it was like screamingly undervalued.
It suggests the market was pricing the auto business as if it was practically worthless, ignoring that huge safety net.
Totally. The cash cushion basically made the whole cyclicality argument much less scary. The risk was way lower than people thought.
That calculation fundamentally changes how you'd view the stock.
And it wasn't just Ford. You saw similar things elsewhere. Boeing, for example, in early '87. Stock was in the low $40,
Okay.
but they had about $27 per share in net cash. Again, the effective price for the actual aerospace business was way lower. It just confirms how important checking that net cash position is for understanding stability.
Lesson 1 then.
Yeah.
Always check the net cash. It sets the floor, tells you about survivability, and reveals the true price you're paying.
Oh.
Okay, so if cash is the safety buffer, let's talk about the buried treasure, hidden assets.
Right. If cash is the floor, these hidden assets are more like finding hidden value in the walls or attic, assets that are on the books for way less than they're actually worth.
Why does that happen? Is it deliberate?
Not usually deception, no. It's more often just a quirk of accounting rules, particularly one called the historical cost principle.
Historical cost, meaning
Meaning many assets, especially things like land, real estate, even some types of inventory, have to be recorded on the company's books at whatever price the company originally paid for them. Decades ago sometimes.
regardless of what they're worth now.
Exactly. Inflation, market appreciation, none of that matters for the book value under this rule.
Okay, let's make this concrete. You mentioned inventory. What about something like precious metals?
Handy and Harman is the classic example here. They manufactured products using gold and silver.
Okay.
So back in 1987, their official book value was listed as $7.83 per share. Sounds pretty precise, right?
Yeah.
But here's the catch. The gold and silver inventory they held was recorded on their books at prices they paid maybe 30 years earlier.
30 years. So silver they bought at, 50 cents an ounce was still listed at 50 cents an ounce.
Pretty much. Gold valued at maybe $415 an ounce on the books, silver at completely outdated prices. But when analysts actually calculated the market value in 1987 of just the metals inventory, just the gold and silver they physically held,
What was it worth?
over $12 per share.
Wait, the metal alone was worth $12 a share, but the entire company's book value was under $8.
You got it. More than the entire stated worth of the company. Which means, effectively, the market was valuing the actual operating business, the factories, the know-how, everything else at less than zero, like negative $4 per share.
That's incredible, just because of an old accounting rule.
It shows how distorted things can get when historical cost meets assets that appreciate significantly, like commodities. The company was basically on sale for less than its scrap metal value.
So that's inventory. Does this historical cost thing apply even more dramatically to things like land, real estate?
Oh, absolutely. Real estate and railroads are probably the poster children for this. Think about Santa Fe Southern Pacific.
The railroad?
Yeah. Back then, it was described as California's largest private landowner. They held something like 1.3 million acres across 14 states.
1.3 million acres. That's huge. How big is that?
It's about 4 times the size of the entire state of Rhode Island, just massive tracts of land.
And this land, presumably acquired way back when.
Exactly. Bought maybe a century ago to lay track, secure mineral rights, whatever, and on the company's books. Carried at next to nothing, basically zero value.
But obviously worth a fortune in reality. Did they ever monetize any of it?
Well, yeah, sometimes bits and pieces. There's a great anecdote about CSX, another railroad. They sold just a small piece of land, an 80-mile railroad right-of-way strip down in Florida.
Okay, just a thin strip of land.
Right, sold it to the state. And that single sale brought in $264 million after taxes.
$264 million. And the book value of that land strip was?
Almost zero. It perfectly illustrates the point. These companies were sitting on billions in latent real estate wealth that just didn't show up in the standard financial metrics people look at.
Mind-blowing. Okay, so we've got physical assets, covered metals, land. What about things you can't touch? Intangible assets. Brand names, contracts, things like that.
Right. This brings us to the concept of goodwill.
Goodwill. That's the premium you pay when you buy a company,
Yeah.
above the value of its physical stuff.
Exactly. It represents the value of things like brand reputation, customer loyalty, exclusive rights, the stuff that allows the business to earn superior profits beyond just its factories and machines.
And accounting rules, again, sometimes make this value seem like it's disappearing.
Yeah, that's the irony. Especially under older rules, companies often had to amortize this goodwill, meaning they had to gradually write it down on the balance sheet over time, suggesting the asset was losing value.
Even if the underlying business was actually growing stronger.
Precisely. Coca-Cola Enterprises is a fantastic case study here.
The bottling operations.
Yes, they carried a huge amount of goodwill on their books, like $2.7 billion related to their exclusive bottling franchises. This represented the premium value of having those guaranteed territories.
Okay. And the accounting rules set.
The rules basically required them to slowly erase this $2.7 billion asset from their balance sheet over a set period.
But the actual bottling business itself, presumably, was doing great, making money.
Absolutely thriving. And here's the kicker. In 1987, Coca-Cola Enterprises actually reported earnings of 50 cents per share, while at the same time taking a significant write-off charge for that very goodwill.
So the accounting entry said value down, but the cash register said value up.
You nailed it. The accounting showed a declining asset, but the real-world business, the cash flow from those exclusive bottling rights, was growing stronger every day. It shows you have to look at the cash the intangible asset generates, not just the accounting entry trying to make it vanish.
That's a crucial distinction. Focus on the cash flow, not the arbitrary write-down. Okay, let's pull this together. We've seen two big adjustments you need to make in fundamental analysis.
Right.
First, adjust the stock price for the net cash buffer of the Ford method. That tells you the real price and the immediate risk level.
Check the cash cushion.
Second, actively hunt for those hidden assets, undervalued inventory like Handy and Harmon's metals, land carried at zero like Santa Fe's, or valuable intangibles like Coke's bottling rights that accounting tries to hide.
Yeah, look beyond the surface balance sheet.
Doing these things gives you a much truer picture of a company's real worth and its ability to survive tough times.
Absolutely. And, speaking of survivability and risk, there's one more related point that's just as critical, tying back to that balance sheet strength.
Oh, what's that?
It's the type of debt a company has. The quality, or maybe the structure of its debt, is just as important as its cash position when things get rough.
Really? I mean, isn't debt just debt? Too much leverage is risky, period.
Not quite. There's a huge, sometimes life or death, difference between what we call demand debt and funded debt. It often determines who makes it through a crisis and who doesn't.
Okay, explain demand debt. What is that?
Demand debt is usually short-term stuff, like bank loans or commercial paper. The critical feature is that the lender, the bank, can often call the loan. They can demand their money back quickly, especially if the company starts showing signs of trouble or breaks a loan agreement covenant.
Ah, so if the company hits a slump, the bank can basically panic and pull the plug.
Exactly. The bank gets nervous, refuses to renew the loan, and suddenly the company faces a liquidity crisis, maybe even bankruptcy, even if the underlying business is potentially salvageable.
Okay, that sounds dangerous. What's the alternative? Funded debt.
Funded debt is typically long-term corporate bonds. Think 15, 20, sometimes even 30-year maturities. The key difference is bondholders generally cannot demand their principal back early just because the company hits a rough patch.
Unless the company actually defaults on an interest payment.
Right. As long as they make their interest payments, the company usually has until the bond's maturity date decades down the road to repay the principal.
That seems like a massive advantage in a downturn.
It's huge. It gives the company breathing room, runway. A company struggling but financed with long-term bonds has time to restructure, cut costs, sell assets, whatever it needs to do to turn things around. A company relying on demand debt might just get forced into liquidation by nervous bankers.
So the structure of the debt determines whether a difficult period is survivability or potentially fatal.
It's absolutely critical for assessing true risk. Knowing whether a company's debt can be called away suddenly versus having patient long-term capital makes all the difference.
That is a fantastic final point for you, the listener, to really think about. We've learned to look past the headlines, adjust for cash, hunt for hidden assets.
Yeah.
But now also, when you assess risk, ask, what kind of debt does this company rely on?
Is it the kind that gives them time or the kind that can pull the rug out from under them?
That deeper level of analysis, well, that's the key to truly understanding a company.
It really is.
So as you do your own research, consider that debt structure. What would you prefer in a company you are investing in for the long haul? That's your deep dive mission. We'll catch you next time.
Welcome to the deep dive. Today, we're digging into something really crucial. This whole idea of constantly rechecking the story around companies.
Absolutely. It's about looking past the hype, right? Past the exciting narratives.
Exactly. Our sources really hammer this home. You need to see if a company actually still has room to grow beyond just, good quarterly earnings.
Right. You got to ask every few months, okay, what's the real engine for growth here? Is it still firing?
Which leads perfectly into this framework our sources lay out, the 3 phases of a company's life cycle.
Yeah, that's a neat way to think about it. First up, you've got the startup phase.
Okay.
This is when everything's new, kind of messy. They're figuring out the product, the market, working out all the kinks.
So pretty risky for investors then.
Oh, definitely the riskiest. High potential, sure, but lots can go wrong.
Okay, so if they survive that, they move into the rapid expansion phase.
That's the sweet spot. The formula is working. They've found their groove.
And they just duplicate it.
Basically, yeah. Roll it out into new areas, new markets. It's predictable, often safer growth. Our sources say this is where most investors make their money.
But, that can't last forever, right?
Yep.
So,
Eventually, you hit phase 3, saturation, or sometimes called the nature phase.
the limits.
Exactly. You run out of easy places to expand, growth slows way down, and suddenly boosting earnings gets really, really tough.
Yeah, the Sensormatic example really brings that saturation trap to life.
Security systems, right?
Right. Huge growth. Stock flew from like $2 to $40. Amazing run.
But then,
Then they just ran out of runway. The source literally says, no new stores to approach.
Yeah.
The growth engine just sputtered out,
the stock.
collapsed. Down to around $5 from over 40. Just brutal.
Ouch. And Sears is kind of the classic example, right?
Oh.
Covering every major mall. Where else do you go?
Precisely. Once you're everywhere. That's saturation.
But McDonald's is interesting here. They seem to fight it off.
Yeah, McDonald's is a great case study in managing saturation. At least for a while. They got creative. Like drive-thrus.
Drive-thrus, breakfast was huge, pushing hard into international markets. They found new ways to grow the existing business, even if new store openings slowed in the U.S.
So they innovated within their limits. It bought them time, even if the market wasn't willing to pay as high a price for their earnings anymore, that PE ratio compressing.
Right, PE fell from maybe 30 down to 12, but the core business stayed strong because they kept finding growth levers.
Okay, so that's company saturation. But what about when the whole industry is, precarious, like the airlines?
No, that's a different beast. The sources point to Texas Air. Remember, they owned Eastern and Continental.
Vaguely, yeah. Messy situation.
Very messy. The airline business itself is just tough. High costs, infrastructure limits, intense competition. It's precarious.
And Texas Air, people got sucked into a story.
Totally. Back in '87, the story was all about turning Eastern around, cutting costs, making it lean. Sounds good, right? But people missed the giant red flag, the debt. Texas Air owed more money than all the other major U.S. airlines combined.
Wow, that's staggering.
It was unsustainable. But the narrative, the turnaround story, was exciting.
So the stock plummeted.
Oh, yeah. From $12 down to $3, people focused on the drama, the union fights, the terrible service reports, and ignored the fundamental financial rot.
And while everyone's watching that dumpster fire,
They missed the quiet winner, Delta, Eastern's main competitor.
what was Delta doing?
Just making solid, steady improvements, fixing operations, nothing flashy.
And their stock.
While Texas Air was crashing, Delta stock actually climbed from around the high 40s, low 50s, up to maybe $55 by mid-'88, just steadily chugging along.
So the takeaway for you, the listener, seems pretty clear.
Yeah, don't be like Don Quixote, as the source puts it. He was enamored with some rosy earnings prediction for Texas Air.
Like $15 a share, they thought.
Something like that. But he ignored the obvious signs right in front of him. Lost bags, terrible schedules, unhappy workers. The basics were broken.
And a new plan doesn't fix fundamentally broken things, whether it's the company's finances or just the industry itself.
Exactly. So the question you need to ask yourself when you recheck that story is, are you betting on real innovation within that expansion phase? Or are you just hoping a company can patch up a failing story because they've already hit the saturation wall?
Look past the pitch, look at the limits, good place to leave it. Welcome to the deep dive. Today, we're digging into something that probably drives a lot of investors crazy: stock research. Hours and hours of it.
Right. And we've got this source material, a kind of final checklist that claims it can really streamline things, cut down that time significantly.
Exactly. The goal is not to become, as the source puts it, a Dead Sea scholar wading through endless annual reports. I mean, who hasn't spent ages on footnotes that, well, change nothing?
It's about working smarter. And the core idea here is this framework, classifying stocks into 6 types. It helps set expectations.
Okay, classification. But before we even get there, the source mentions some essential filters, things you check first.
Yeah, absolutely. Foundational stuff like the PE ratio.
Price to earnings. Lower is generally better compared to similar companies, right? Signals value.
Correct. But interestingly, the source also flags lower institutional ownership as potentially positive.
That seems counterintuitive. If the big funds aren't interested, wouldn't that suggest, I don't know, a problem? Or maybe it's just ignored.
That's a fair point. But the thinking here is, if institutional ownership is low, say below 25 or 30%, the stock hasn't been fully discovered yet.
Ah, okay. So there's potential upside if the institutions do eventually pile in.
Precisely. Plus, you look for other green flags.
Yeah.
Insiders actually buying shares, and crucially, a solid track record of earnings growth. Consistency matters.
Got it. And there's this concept about cash position. They use Ford as an example, having $16 in net cash per share after debt. How exactly does that protect you?
Well, think of it like a floor under the share price. It's tangible value. That cash gives them options: pay down debt, survive a downturn, buy back stock. It's a real buffer.
Right, a buffer, hard assets, not just projections. Okay, so once these initial filters are passed, we get to the categories. Let's talk about the first few. Stalwarts, the defenders.
Yes, stalwarts. These are the big established players, companies that are really hard to kill off. Think huge brands, market power.
Like McDonald's, Kellogg's, those kinds of names.
Exactly. The source mentions them, Bristol-Myers too, especially how they held up during big market shocks like in '87 or the '73-'74 slump.
So for stalwarts, the check isn't explosive growth, but more like steady long-term performance. Can they keep growing, even slowly?
That's the idea. Sustain momentum. Now contrast that with fast growers.
Okay, the high-risk, high-reward category. The source talks about aiming for 20 to 25% earnings growth here.
Yes, but you have to be really careful. You need to dig in. Is the product really the engine driving that growth? Is it sustainable?
Because if growth slows down.
It can get ugly fast. The source gives the example of Sensormatic electronics, anti-theft devices. Great growth, then it slowed just a bit.
And the stock.
Plummeted from like the high $40 down to $6 in just a year. Shows how quickly sentiment can turn on these.
Wow. Okay, a cautionary tale. Then there are the turnarounds, the rescuers. What's key when looking at a struggling company?
Again, it often comes back to basics. Cash and debt. Can they survive? Apple, even when struggling back in the day, apparently had a couple $100 million in cash. That buys time.
And strategy matters too, right? Like shedding unprofitable parts of the business.
Absolutely. Texas Instruments is the classic example mentioned. They sold off their home computer division, which was losing money.
And the market reaction.
Very positive. The stock jumped significantly from around $101 to $176 pretty quickly. It showed discipline.
Okay, so stalwarts, fast growers, turnarounds. We should probably quickly mention the other 3 categories just to complete the picture.
Good idea. There are cyclicals companies tied to the economy's ups and downs, like automakers or airlines. Then asset plays, where the value is hidden in assets like real estate or patents, not current earnings.
And the last one?
Specials. These are unique situations, maybe a spin-off, a potential takeover target, things like that. Each needs its own specific kind of research. Knowing the category just focuses your effort.
Right. Which brings us to the overall mindset. What kind of discipline does this approach require from the learner?
A few key things. First, dedicate real time, at least an hour a week, they suggest, for actual research, not just checking quotes.
Okay, consistent effort.
Second, tune out the noise. Avoid those super hot stocks or sectors that suddenly jump 50 or 100%, often bubbles.
Don't chase hype. Makes sense.
Also, don't get fixated on tiny price moves. And crucially, never buy just based on stated book value alone. Focus on the real underlying value. What's it actually worth?
So wrapping this up for our listeners, the big takeaway seems to be classifying a stock gives you a framework. It helped you understand what to look for, what to expect, and where the risks might lie.
Yeah, it helps you ask the right questions for that specific type of company. Saves a lot of wasted effort.
Definitely saves time. And we'll leave you with this final thought from the source, a very practical comparison. You should apparently invest at least as much time and effort in choosing a new stock as you would in choosing a new refrigerator. Food for thought. Welcome, everyone. Our mission today, it's a really crucial one, designing a successful investment portfolio. We're going to deep dive into the source material you sent over.
That's right. And try to separate, the realistic goals from some, frankly, dangerous assumptions that,
Yeah,
that seem to trip up a lot of investors.
absolutely. And maybe we should start with the biggest one, this idea of returns.
We really have to. The sources, they're very clear on this. So many people, maybe even most people starting out, expect like 25, maybe even 30% returns every year.
Wow. Yeah, that sounds amazing, of course. But expecting that year after year,
Yeah.
it's not just unrealistic, is it? It sounds downright destructive.
It really is. It leads straight to impatience, frustration, and, panic selling when things inevitably don't go quite that smoothly.
So what's the reality check then? What's the baseline?
Okay, so the baseline, the sort of generic long-term return for stocks, is around 9 to 10% a year. That's what you typically get just by investing passively.
Like in an S&P 500 index fund, something like that?
Exactly. Just buying the market average. So
Right.
that 10%, give or take, that's your benchmark. It's absolutely essential to understand that.
Okay, right. Let's unpack that a bit. If 10% is what I get for doing, well, basically zero homework, what's a realistic goal if I'm actually going to put in the effort, if I'm actively picking stocks?
Well, if you are actively picking and you're good at it, maybe 12 to 15% compounded over time. That seems achievable based on the material.
12 to 15%.
But, and this is really, really important, that's after factoring in all your costs, commissions, fees, everything.
Wait, hold on. 12 to 15% is the goal just to justify the effort and risk over the index. That upside feels kind of limited. Why bother?
Because those costs you mentioned, they're a killer, a real trap. The sources give this example. Say you pay a 4% commission on a trade.
Okay.
Right away, you're starting 4% in the hole on that investment. Now, if you're trading frequently, let's say buying and selling 4 times a year.
That's 8% round trip times 4, so
Yeah.
16%.
You got it. You're down 16% before you've made a single cent in actual profit.
Yeah.
You need that 12 to 15% return just to break even on the fees sometimes.
Okay, that makes sense. So beating the index is tough largely because of those costs.
Yeah.
Which suggests that if you're going to be active, you need real focus, right?
Exactly. And that leads us straight into this whole diversification debate. How many stocks should you actually own?
Yeah, the sources seemed a bit conflicted. Put all your eggs in one basket and watch that basket versus the classic, don't put all your eggs in one basket.
Right. But the material we looked at leans heavily against owning, say, hundreds or even like 1,400 stocks.
1,400? Seriously?
Yeah, they call that diversification or foolish diversity. It's like buying too much insurance. It just guarantees you'll get average results and nothing more.
So you don't need 50 or 100 companies. For a smaller portfolio, the sources suggest it's actually safer to own maybe 3 to 10 stocks. Is that right?
That's the argument. Between 3 and 10 well-researched stocks.
Okay, but why? What's the real benefit of concentrating like that? Isn't it riskier?
Well, the potential benefit, the big upside, is dramatically increasing your odds of finding a real home run. What the sources call a 10-bagger, a stock that goes up 10 times what you paid for it.
Ah, okay. So if a stock is only 1% of your portfolio, even if it doubles or triples, it barely makes a difference overall.
Precisely. But if you have a focused portfolio, maybe 10 stocks, and one of them becomes a 10-bagger, that actually moves the needle, makes a huge difference to your total return.
Makes sense. So if we connect that idea, owning just a few carefully chosen stocks, how do you manage them day to day? There's that old saying, right? Pull the flowers and water the weeds. Sell your losers, keep the winners.
Yeah, but the source material we reviewed, it flips that completely on its head.
Really? How so?
It argues you should do the opposite, essentially. Avoid that emotional pull to just sell your losers because the price went down. Instead, the strategy is more about active rotation.
Rotation. Meaning?
Meaning you might sell a stock that's done really well for you, maybe a solid company that's up 40 or 50%,
Wow.
and then reinvest that capital into a new promising idea you've researched. You're sort of harvesting the gains from the strong performers.
Instead of selling the ones that are down 15% just because they're down.
Exactly.
Yeah.
Because the moment you sell a fundamentally good company, just because the stock price dipped, you lock in that loss. You guarantee it. and you might miss out on a huge recovery later.
And didn't the source have an example? Something about Taco Bell?
Yes, a classic one.
Yeah.
Taco Bell stock apparently had a massive drop early on. Investors who panicked and sold locked in huge losses. But the ones who understood the business ignored the dip and held on. They saw something like a tenfold return eventually. Selling on the dip was the worst possible move.
Which really highlights the danger of things like automatic stop-loss orders, doesn't it?
Absolutely. The sources are pretty critical of them.
Right.
Setting an order to automatically sell if a stock drops, say 10 or 15%, given how much markets fluctuate, those stop orders almost guarantee you'll turn a temporary dip into a permanent loss. You end up forced to sell perfectly good companies at the worst possible moment.
Okay. So pulling this all together, the key takeaways seem to be manage your expectations. 10% is the baseline. Maybe 15% is a great ambition for active picking after costs.
Yeah.
And be focused. Owning just 3 to 10 stocks you really understand might actually be safer, or at least more potentially rewarding than owning hundreds you don't.
That sums it up pretty well. And maybe one final thought here. Something fascinating is how portfolio design isn't static. It should probably change as you age.
How do you mean?
Well, younger investors, they have decades of earning potential ahead. They can afford to take more risk, maybe aiming for those 10-baggers. But older investors, they might need to live off the income their portfolio generates. Their focus shifts dramatically towards stability, dividends, maybe lower volatility.
That's a really important point. It raises a big question for everyone listening, doesn't it?
It does. How might your current life stage, your own financial situation right now, influence how you apply these portfolio design ideas we've just discussed? Something to think about. Okay, let's unpack this. This deep dive is really for you, the learner, our mission. Well, it's pretty focused. We want to cut through all that noise, the market sentiment stuff. No predictions here. We're aiming to pinpoint the real best times to buy and sell stocks based purely on observable conditions.
Right. And the core idea, it doesn't really change. Success comes from finding good merchandise, quality stuff at a bargain price. Now, while you can look for that every day, our research shows there are really 2 specific times when the whole market kind of loses its head. And that's when these incredible bargains consistently pop up.
Okay, let's start with buying then. You mentioned 2 periods. The first one you call the annual year-end cleanout, usually October through December. Why does that time create such a predictable opportunity?
Well, it's basically a mix of things. You've got institutional investors, the big players dumping their losing stocks, the dogs, as they say. They do it for tax reasons, mainly, but also just to tidy up their portfolios before the year-end reports. Nobody wants bad performers on the books.
Makes sense.
And this selling, it's often pretty indiscriminate. It pushes prices down, especially for maybe lower-priced stocks, creates real chances if you're looking for solid companies, not just following headlines.
Got it. Okay, period 2 sounds intense. Market collapses, big drops, free falls. That sounds terrifying, frankly. How does someone, the average person, figure out if a company is just temporarily down or actually broken when everything's crashing?
That's the crucial part. During these really scary times, perfectly solid companies get sold off right alongside the genuinely weak ones. It's panic selling. Think back to, say, the 1970s to 74 panic. A blue chip like McDonald's, its stock got hammered, fell nearly 75%.
Wow, 75%.
Yeah, from about $15 down to $4. That's the kind of irrational fear we're talking about.
Oh, yeah.
The company's fundamentals were okay, but the price just got crushed by general panic. Or think about the 87 break. Same story. Lots of fundamentally sound companies got thrown out just because traders were scared or needed liquidity fast.
Okay, so buy when there's fear in the air. But then selling. If fear is the trap when buying, I guess greed is the trap when selling. How do we actually know when it's time to get out, even if the market's still buzzing about the stock?
You really have to resist what some sources call the drumbeat effect. It's that constant noise from both amateurs and professionals whispering in your ear.
Whispering what?
Well, sometimes it's greed talking, like your broker calls, hey, congrats, you doubled your money, maybe take some profits. Other times, it's panic. Predictions of doom, maybe based on some economic indicator like the M1 money supply worries people used to obsess over.
Resisting that sounds really hard. You mentioned the M1 thing. What was that about?
Yeah.
And how do you build that mental filter? How do you know that stuff is noise? But say, losing market share for 2 years, that's real.
Yeah. The M1 panic was this widespread fear that this particular money supply measure was growing too fast and it was going to cause massive inflation. Turned out the metric itself was a bit flawed in that context, but it froze a lot of investors with fear. The point is, These big, generalized economic fears, they often fade. You have to focus on concrete signs of decay inside the company you own, not external rumors.
Okay, let's get concrete then. Sell signs for different types of stocks. What about slow growers first?
Right. For a slow grower, you sell when its core business starts sputtering, the clearest sign, losing market share 2 years running, or maybe the company's just coasting, cutting R&D, not innovating anymore, or making a bunch of weird acquisitions that don't fit. That often signals they're distracted.
And the exciting ones, the fast growers. When does that party usually end?
Two main things: valuation getting crazy and the growth itself stalling. Sell when the PE ratio gets into what you'd call absurd dimensions. Think PEs of 50, 60, or even higher, like Polaroid or Avon back in their heydays.
Okay, stratospheric PEs.
Exactly, and also look for internal signs of trouble. Key people leaving, maybe. Or if same-store sales drop noticeably, say 3% or more, that signals the growth engine is starting to sputter. The high valuation just isn't justified anymore.
Makes sense. Lastly, turnarounds.
Mm.
These seem like they need the most patience.
Oh, absolutely. Buying a turnaround is risky, right? The temptation is huge to sell the minute it recovers a little bit. But the best time to sell a turnaround, it's usually only after it's actually fully turned around, when the problems are clearly fixed. Think about GPU, General Public Utilities, after the 3 Mile Island accidents. The stock went from $4 to $12, but only after the second unit was back online. The story was resolved.
Ah, so wait until the recovery is undeniable.
Precisely. You wait until the fundamental narrative is resolved, and maybe it's time to reclassify it as just a normal company again.
So wrapping this up, it really sounds like true success comes down to tuning out the emotional noise, tuning out the generalized fear when you're thinking of buying, and the loud greed when you're thinking of selling. And instead, just focusing purely on what's happening inside the company, its actual health.
Exactly. And this brings up a really important question, something for you, the learner, to think about. Let's say you find a stock, a real winner. It goes up 5 times. Then it goes up another 5 times, a 25-bagger. And the fundamentals still look great, rock solid. But everyone is telling you, take your profits, lock it in. A sure gain is better than a possible loss. How much emotional pressure can you withstand? How much does it take to stick with your original analysis when all that noise is telling you to sell? That's something worth considering next time the market gets really noisy.
Welcome to the Deep Dive. Today we're going to tackle some really common, almost superstitious things people say about stock prices.
Yeah, things that sound smart maybe, but are actually, well, pretty dangerous for investors.
Exactly. Our mission here is to cut through that, the noise and look at what actually makes sense. Let's start with a big one. If it's gone down this much already, it can't go much lower.
Oh, that one's everywhere. It's fascinating, isn't it? People get so anchored to the price history, like somehow the fall itself creates a safety net.
Right. As if gravity stops working at some point.
But, fundamentally, there's just no rule like that. A stock price reflects the business. If the business goes bust,
It can go all the way down.
all the way to zero. It happens. There's no magic number. It has to stop that.
We saw that happen so dramatically with Polaroid, didn't we?
Oh, absolutely. A textbook case.
People kept saying that exact phrase, it can't go lower, even as it careened down from over $140.
143.5, I think it was.
Right, down to like $3.50
Yeah.
in less than a year.
And imagine holding on, just repeating that phrase while your investment disappears. It's a psychological trap.
It's brutal. And it's not just, average Joes. Even the pros fall for it.
That's true. You mentioned Kaiser Industries. There is a well-respected Fidelity analyst.
Yeah, recommended around $25, right?
Exactly. And even when things looked shaky, when it dropped significantly, people held on thinking, okay, this must be the bottom.
But it wasn't.
Nope. It kept falling, went below $7.50 eventually. The floor just kept dropping out. It shows how illusory those price levels can be.
So that belief that a stock has hit some kind of unbreakable floor, that's one big error. But the flip side is just as bad, isn't it?
You mean the idea that if it's gone this high already, how can it possibly go higher?
Exactly that one. Like success has some kind of built-in numerical ceiling. It just can't break through.
Well, again, why should it? If a company keeps performing, keeps growing its earnings, keeps innovating, why should the stock stop rising?
Good point. There's no arbitrary limit written in the sky.
Think about Philip Morris way back. If you bought it in the 50s or 60s, maybe at the equivalent of 75 cents a share,
Okay.
you might have gotten nervous when it doubled or tripled. You'd think, okay, this is too high now, time to sell.
Makes sense psychologically.
But if you held on, If you ignored that feeling.
Massive returns, right? Wasn't that a 23 bagger or something?
Exactly. Huge, huge returns over time. It shows that strong fundamentals can keep driving a stock way past where people think it should stop. The company's success just keeps surprising people.
But achieving that kind of return takes incredible patience. And that brings up another sort of dangerous thought people have. It's taking too long for anything to ever happen.
Patience. Or the lack of it. That's a big one.
Mm-hmm.
The market's timeline is often much, much longer than our personal attention spans.
Like with Merck. That's a snuck
A
example.
really critical one. Think about it. Their earnings were basically flat. No growth. For 9 years.
9 years. From 72 to 81.
That's right. Imagine holding a stock for 9 years and seeing nothing happened with the earnings. People just got tired. They sold.
I can understand that. 9 years is a long time to wait for zero.
It takes real discipline, maybe focusing on the fact that the underlying business was still solid, even if the numbers weren't jumping yet.
And then what happened?
Well, eventually, in the 80s, the growth kicked in. Big time. And those patient investors who stuck with it, they were massively rewarded. It proves that sometimes the payoff comes in year 10 or year 15, not year 2.
So, tying this all together, what's the core takeaway here?
I think it's that stock prices aren't ruled by these simple, arbitrary numbers, floor ceilings, timelines in our heads.
It's not about the number itself.
No, it's driven by the fundamentals, the actual performance of the company. It requires critical thinking, real analysis, and a good dose of patience, not just reacting emotionally to the price swings.
Okay, so ignore the noise.
Yeah.
Focus on the business. Got it. Now, here's the final thought for you, our listener, to kind of chew on. How dangerous is it to use the share price level as a measure of risk? You hear it all the time. It's only $3 a share. What can I lose?
That's a classic illusion. The idea that a low dollar price means low risk.
But it doesn't, right?
Not at all. Whether you buy a stock at $3 or $43, the maximum you can lose is everything you invested. 100%.
So the percentage loss is identical.
Exactly. A $3 stock can still go to zero just as easily as a $43 stock, believing it's less risky just because the price tag is small. Well, that often encourages people to gamble on weaker companies.
So don't confuse a cheap price with low risk. The potential downside, in percentage terms, is always the same, 100%. Something to keep in mind. That's our deep dive for today. Welcome to the deep dive. Today we're looking at some sources that really take aim at the conventional wisdom around investing.
Yeah, they're pretty critical. They frame things like options, futures, even short selling, not as tools, but more like, investment gimmicks. Hide bets, basically.
High-stakes side bets. And
Yeah.
the statistics they pull out are, frankly, kind of staggering.
They really are. We're seeing figures suggesting that somewhere between 80 and 95% of non-professional traders lose money on these things.
Wow. 80 to 95%. That's huge. It almost sounds worse than Vegas.
The odds certainly aren't great for the average person jumping in.
It feels like a real shift, doesn't it? Like the old idea of, buy a share in America, just owning a piece of a company.
Right. That seems to be getting overshadowed, at least in some circles, by this impulse to take a flyer at the New York Futures Exchange. Much riskier.
Okay, but let's be fair. Futures did start with a legitimate purpose, didn't they? It wasn't always just speculation.
Absolutely. There was one core, very useful function: price insurance.
Yeah.
Especially in commodities.
Like a farmer.
Exactly. A farmer worried about the price of wheat collapsing before harvest could use a futures contract to lock in a price. It provides stability. That's crucial.
But that original use, it's not the main event anymore.
Not even close, according to these sources. The vast, vast majority of trading now is speculation. It's detached from the actual producers and consumers of the goods.
Okay, so let's dig into that speculative side, particularly options and futures. The sources call them a zero-sum game. What does that mean exactly?
It means for every single dollar someone wins in that market, someone else has to lose a dollar. It doesn't create new wealth, it just shuffles it around.
The transfer payment, basically.
Precisely. A
Yeah.
transfer payment, as one source puts it, usually from the unwary to the wary.
That leads us to that sure thing tragedy example. Can you walk us through that? It sounds like a cautionary tale.
It really is. So imagine you've got $3,000. You could buy, say, 150 shares of Sure Thing Inc. at $20 a share. Straightforward investing.
Owning a piece of the company.
Right. Or
Yeah.
you could take that same $3,000 and buy options. Let's say you buy 3,000 call options, giving you the right to buy the stock at $20 later, and you pay $1 per option.
Okay, so $3,000 gets you control over way more potential shares. Leverage.
Huge leverage. If the stock price rockets up to, say, $35, your options are suddenly worth a ton. You could make $45,000.
Wow, okay. That's the lure.
That's the dream. But here's the trap. What if the stock price just stays flat? Maybe it goes up a little, maybe down a little, but it doesn't hit that magic number by the expiration date.
Then what happens to the options?
They start losing value purely because time is running out. And if the stock is still at $20 when the options expire, poof, your entire $3,000 premium is gone. Worthless.
Even if the company itself is perfectly solid.
Even if you did your homework and picked a fantastic company, the option itself expired worthless. That's why the source says this market doesn't finance anything. It's just that transfer.
And these aren't just individual risks,
Yeah.
right? The sources connect this to broader market instability.
Definitely. They point straight at the 1987 crash. Remember portfolio insurance?
Vaguely. It was supposed to protect big investors.
Yeah, it was this strategy using futures and options. Institutions would automatically sell futures when the market dipped, trying to hedge their stock portfolios.
Okay.
But when everyone did it at once, the automatic selling just fed on itself, creating a downward spiral, a feedback loop that accelerated the crash. It's cited as a principal culprit.
Which makes you wonder about these instruments, especially when you hear what some experts think.
Like Warren Buffett. The sources mention his view is pretty stark.
What does he say?
He apparently thinks stock futures and options should just be outlawed, period.
Outlawed entirely. That's quite a statement from someone like him.
It's a very strong critique, yeah. Okay, let's switch gears slightly to the last piece. Short selling.
Borrowing trouble, as they say. How does that work again?
Well, the analogy used is like borrowing stock from your neighbor, selling it immediately because you think the price is high, and then hoping the price crashes so you can buy it back much cheaper, return the shares to your neighbor, and pocket the difference.
Sounds a bit sneaky. One source called it borrowing with criminal intent.
It's definitely playing against the company, but the potential payoff can be huge. Think about that Polaroid example.
Right. Shorting it at $140.
Exactly. You short 1,000 shares, get $140,000 credited to your account, then the price collapses to $14.
So you buy back the shares for only $14,000.
Right. Return them, and you've made a $126,000 profit. That's the allure.
But there's a catch. A big
A
one.
massive one. Infinite risk. See, when you buy a stock normally, the most you can lose is what you put in, right? It can go to zero.
Okay, yeah. Limited downside.
With shorting, if you're wrong and the stock price soars instead of drops, well, you still have to buy back those shares you borrowed.
At the new, much higher price.
At whatever sky-high price it hits. If that Polaroid stock had doubled to, say, $280 instead of crashing.
You need $280,000 to replace something you only got $140,000 for initially.
Exactly. You lose $140,000, and there's no theoretical limit to how high a stock can go. That's why they say infinity is where a shorted stock always appears to be heading.
And this isn't just theoretical risk. People have actually been wiped out by this.
Oh, yeah. The sources mention Robert Wilson, known as the smart investor. He shorted Resorts International. The stock went parabolic from around $70 to like $770. His losses were apparently in the tens of millions, $20, $30 million. Gone.
Just staggering, even if he was eventually right about the company's fundamentals.
Doesn't matter if you can't survive the squeeze. The market can stay rational longer than you can stay solvent, as the saying goes.
So wrapping this up, we've looked at options, futures, short selling, and the picture painted by these sources is pretty consistent. High complexity, high risk, and for most non-professionals, pretty unfavorable odds.
Yeah, despite the potential for those headline-grabbing wins, the overwhelming theme is risk and loss for the average person trying to play these games.
It really makes you think. If the odds are so stacked against everyday investors, and even legendary figures like Buffett are deeply critical, what keeps these markets so popular? What's the enduring appeal of these high-stakes side bets?
That's the big question, isn't it? Something perhaps for you, the listener, to ponder as you navigate your own financial decisions. Welcome back to the Deep Dive. Today, we're going to dig into some stock market history, specifically the 1960s through the 1980s. We want to see how big events, crises, politics, how they maybe didn't move the market the way you'd think.
Exactly. And the core idea, really, is questioning this assumption that the pros, the experts, always have it figured out.
Okay.
Because there's this tendency to panic, right? But also this contrarian idea. The source mentions 50,000 Frenchmen can be wrong, but it's more like 50,000 stockholders.
Right, the crowd.
Yeah, the crowd rushing to buy or sell. The thing is, They're usually only right for maybe the last 20% of a move.
Only the last 20%. So if I'm trying to figure out what the market's doing.
It means the herd is basically always late. They jump in after like 80% of the rise has already happened, and they panic and sell only after 80% of the drop is over.
Yeah.
So the real chance is often, when everyone else is freaking out.
Okay, let's look at some real examples. Big crises. What about the Cuban Missile Crisis? I mean, nuclear war felt possible.
Yeah, huge scare. But the market, it fell less than 3%.
Wow, okay. And then President Kennedy's assassination, a massive shock.
Same thing, less than a 3% drop. And it bounced back completely in just 3 days.
3 days.
It suggests that these huge political, even existential shocks, the market filters them out really fast, at least in the short term.
And that pattern kind of continues into the 70s, but with maybe less serious stuff like political noise?
Totally. Look at Nixon. He announced price controls. I mean, fundamentally, that's anti-free market, right?
You'd think. Bad for stocks.
But the market went up 3%.
Okay, that's weird.
And then remember President Ford and the whoop inflation now buttons, the win buttons?
Vaguely, yeah. Mostly seen as just symbolic.
Pretty much. But the market shot at 4.6%. It seemed like it didn't care what the policy was, just that anything was happening. Change was good.
So political drama gets ignored. What about real economic shocks, like the OPEC oil embargo, October 73? That must have hit hard.
Now that was different. The market dropped 19% over 3 months.
Okay, that makes more sense.
Yeah, so it shows that while the political noise might be ignored, genuine economic pressure isn't. It wasn't just the oil shock itself, though. Interest rates were climbing fast, too, and that really drove the market down, kind of against the grain of some other fundamentals, perhaps.
Right. The underlying economics matter. But what about just investor psychology? Pure emotion. We should talk about the Monday effect. It's this weird historical trend, right?
It is pretty weird. Since 1953, apparently, the market has lost something like 1,565 points overall just on Mondays.
Why Mondays? You'd think big institutional players would have figured out how to trade against that predictable dip.
Well, the theory is it's pure psychology. People have the weekend, maybe read some gloomy predictions in the Sunday papers, stew on it.
And then sell first thing Monday morning.
That seems to be the idea. Fear builds over the weekend break. It connects to who's trading too.
Yeah.
Institutions dominate, trading fast, but maybe this reflects the mood, spilling over from individuals.
And the source talks about small investors being like short-term churners.
Yeah, and living rent-a-stock companies.
Rent-a-stock. You mean like hot stocks people jump in and out of fast, not long-term holds.
Exactly. Speculative favorites. Renting, not owning. Basically, amateurs chasing the latest surge.
So seeing that history helps you, the listener, maybe not act like that.
That's the hope. Learning to spot that behavior in yourself and others.
Okay, let's boil this down. What are the key lessons here? The so what from all this counterintuitive history?
Well, first, big market drops, corrections. They often turn out to be great buying opportunities. But you have to be quick.
Because the panic doesn't last, like those crises in the 60s.
Right. Less than 3 days sometimes.
Yeah.
The buying window can be tiny.
Okay, what else?
Second, don't even try to predict where the market's going in the next year or two. It's basically impossible. Focus longer term. Because as we saw, stock prices can really move opposite to the fundamentals for a while. You don't need to be right every time, or even most of the time, to do okay.
And we saw that herd mentality play out again near the end of this period, right? August 88.
Oh, yeah. The market jumped 30.7 points one day. Looked like a big rush to buy back in, probably by people who missed the bottom and were chasing the rise.
That chase, the herd desperately trying to catch the surge after it's mostly happened, that's the trap.
That's the trap. Late to the party, like we said.
So, if you take just one thing away from this deep dive today, maybe it's this question. When you invest, what are you actually relying on? Is it solid long-term fundamentals? Or are you just joining that enthusiastic herd trying to grab the last 20%?
Something to think about.